Hello guys, welcome to another training video with Forex Trading Signal. Today guys, we're gonna go to discuss the GDP, the gross domestic product. So we're gonna go to look into the real GDP and the nominal GDP and how those GDPs are calculated. We will look also into the GDP deflator, and we will look also into the GDP and how we can measure the GDP and see the effect in the market. So stay with us, please. We will start in a moment. So at the beginning, guys, I would like to show you again the business cycle, which we have shown you before. And I would like to remind you about this cycle. We said that the element of this cycle are the household and the output market and the input market and the firm. And within this cycle, we can measure the employment of the household, and we can measure the consumption of the household, and we can measure the gross domestic product, and we can measure also the income. So we said that the household is a group of people living under one shelter or living under one house. So what we need to do now, we're going to go to explain this cycle again in simplified manner. So we said that we have a household, and the household a group of people living under one house. So those household, they're gonna go to provide the capital, the land, and the labor to the firm, and the firm will produce outputs, that is the services and goods, and will offer it in the output market, and the output market will sell it to the household. So you can see how the cycle work, starting from the household, going to the input market, to the firm, then the output market, then coming back to the household. This is how the productivity is moving. However, when you look into the money circulation here, you can see that the money is circulating in the other direction. So the output market will give money to the firm, and we call that revenue, because whatever produced in the firm and sold in the output is considered revenue. So let's think about it, that it is money given to the firm, and the firm will pay the wages and the rent and the profit to the input market, which is by the end, it's owned by the household. So we can say this is an income, and this is also an income money. We call this money income for the household. So the household are individual. So now the household, they're gonna go to take the income and they're gonna go to spend it in the output market, and they're gonna go to buy services and goods such as car, food, services, whatever. So you can see how the money circulation happening in this cycle in simplified manner. So now what we need to do, we can measure income in this area, and we can measure expenditure in this area. We call this, when you give money from the household to the output market, we call that expenditure, because you're gonna go to take services and goods, or goods and services, and you're gonna go to give money instead. So we call that expenditure. However, here you're gonna go to offer labor, lands, and capital, and we call that money is income, because it's a profit and rent and wages. So what we are interested now, when we say what does the GDP mean, we are interested to measure the amount of money or the value of the good and the services produced by the market, and we need to see how much it's growing up. So we can measure the amount of money in this area. So why I cannot measure it here? Because this is income. So here in this area, the money measurement or the GDP measurement, we measure the expenditure because it's excluding the tax. Because if we want to measure the income in this area, the household will try to under income, so this measurement will not be accurate. So here we can measure the real amount of money being produced by the economy. All right. So what does the GDP mean? The GDP mean the value of the final goods and services produced within a country in a given period of time. So it's a measurement for the value of the goods and services and that measurement given within period of time. And of course, when we say GDP, this is a measurement for your local country or the country you are trading their currency, or if you are, let's say, like us trading gold, we concentrate in US GDP. So let's see what does the GDP mean. So you can see that we have the symbol Y for the measurement of the GDP, and we say this is the GDP, the amount of the productivity in the market, and that will be equal to C plus I plus Gulf plus net export. And I'm going to detail this now. So Y means is the amount of dollar in the market in this area. So C means it's the consumption of the household. So I means investment. And when we say investment, we doesn't mean that you go to the market and you buy stocks and you buy currencies and so on. This is not an investment. From the economist point of view, this is called saving, because you're gonna go to save your money. You're gonna go to buy, let's say, in the stock market, because you have an amount of money. You are going to the stock market, so you're gonna go to buy stock market, expecting that the price will go up. So you will be end up having more purchasing power. So we call this saving. We don't call it investment. When we say investment in terms of the GDP, we are talking about investment in producing products and services, such as factory to make cars, such as factory to make glasses. So what we mean to say here, it is only the investment where you need to make buildings and put employees and produce something. This is what we mean by investment. We don't mean that you take your money and put it in the bank in saving account. This is not an investment. This is called saving. And the stock market called saving. And whatever we do now, me and you, with the gold, it's called saving. It's not investment. Now, Gulf, it is the government purchases. It is the government spending. So net export. So the net export means export minus import. Because if you are a country, let's talk about USA. If I am in USA and I'm producing product, those product I'm going to export them outside. So however, my country also needs some product which I cannot produce them, or I don't have them minerally. So what I will do, I will import those products. So the GDP is measuring the gross domestic product in the US locally. That is domestic. So the importing goods and services is not produced in the country. So what I need to do, I need to subtract from the export of the US the import. So because the export is contributing in the calculation of the GDP, we need to subtract from it the imported goods and services. Because the measurement for the GDP, it's for the product which is produced within your local country or the US country and sold out internally or externally. So when you have imported the product, that is sold out internally, but that is not produced by the US. Okay? So that is why we say net export, which is export minus import. This is very clear and this is very easy. Let's move to next slide and explain this. I don't want you to pay attention for this. And also I will explain some calculation here, but it's not important too much because everything is calculated for you and made ready for you to use without calculating all those things. However, I want you to understand what does the GDP mean and how it is going to affect the market. So I just want to show you that we can measure the GDP in three ways. We can measure the expenditure, and we just explain this in a moment. So consumption plus investment plus government spending plus the net export. And we can measure the income method. And that is what we have explained a few minutes before. And we said the US is not using that method because the household, they're going to go to under income themselves. So we don't have a real measurement of the GDP. And of course, the product method that is measuring only the product produced by the economy. So let's talk now about one example in 2015, okay? So don't worry, I don't want you to calculate here, but I'm just giving you an example. What does the GDP mean? So you will be figuring out when we speak about the GDP in our Telegram channel, and we start to say, this is bad, this is good. I need you to figure out what is happening with us. So in 2015, the total income of the United States was $17.9 trillion, and the population was 321 million people, million person. So now the personal income or the GDP per capita per person, if you take the $17.9 trillion and divide it by the 321 population, you will end up by having GDP per capita or per person $55,882 for each person. Please note that this number is an average for measuring the GDP, and it is not a number for each individual. This number, some people, they can be having higher income, and there are people, they are having lower income. However, we are measuring the average per the population, and this is a calculation for the average for individual people within the US territory. So if we calculate this real data, I have taken it from 2015 GDP in US. So the consumption of those people, it was $38,218 for each person. Investment was $9,402 per each person, and government spending was $9,919 for each person, and the net export was minus, focus on this, was minus $1,657 for each person. And when we say minus here, coming back to the previous example, what does it mean? That means our import in US is more than our export. That means the US market is importing more than exporting, okay? And this is a fact. Now let's understand how nominal and real GDP are calculated. So I'm going to give you some numbers. So I'm going to give you year, and in the year I'm going to put 2001, 2002, and 2003. And let's think about only two products. Okay, two products. We don't want cars, we don't want factories, we don't want engines, we don't want aircraft, we don't want anything. We want to have two simple products: hamburger and hot dog. Hamburger and hot dog. So I'm going to put here the quantity of the hamburger, and I will call that HB. The quantity of the hamburger in 2001 and the price for the hamburger, $1. And I'm going also to put the quantity of the hot dog, and I will call that HD, and the price for the HD, the hot dog in 2001. And similarly, I will do it for 2002 and 2003. So these are example figures so we can understand how does the GDP is being calculated. So you will be having better idea. So let's talk about the nominal GDP. So the nominal GDP, we are measuring the amount of money produced and spent by household in the output market in that area in the corner top. If you remember the cycle we have explained a few moments ago. So if I would come to 2001 year and I want to calculate the GDP in 2001, so the products are hamburger and hot dog. So I need to know the quantity of the hamburger and the price of the hamburger in 2001, and the quantity of the hot dog and the price of the hot dog in 2001. So that is 100 hamburger in 2001. The price in 2001 for each hamburger was $1. So 100 multiplied $1 plus 50 hot dog in 2001 multiplied by the price of $2 for each hot dog. So this will equal to 200 GDP. So we have $200 of GDP. So let's calculate now 2002. So we have 150 hamburger in 2002, and the price was $2, increase $1. And we have 100 hot dog in 2002, and the price increased to $3. Now I have total GDP of 600. So I have also 200 hamburger in 2003, and the price increased to $3. And I have 150 hot dog in 2003, and the price increased to $4, and the total GDP now is 1,200. So now, if you realize here, we are measuring the prices versus the quantities. So this is the amount of money in that expenditure area. However, we call this nominal GDP, and these will not measure what are the products being produced and what are the growth happening within the productivity itself. It's just showing us money spent in the market and product sold. But however, what I'm interested in is the product being sold in the market and how much is the growth happening on that product. Because if you realize here, the price is going up from year to another and the productivity is going up. So I have had in 2100 hamburger, however in 2003 I have produced 200 hamburger, but the price is going up. So I need to know how much is the change on the productivity, but I don't need to know how much is the change on the price. I don't need to know the inflation. I need to know the productivity. So to do that, we come and we calculate something called the real GDP. And this is what we are interested to see, the real GDP. Okay, so the real GDP is being calculated by using the prices of the base year. So let's see how these being calculated. So if I take 2001 as a base year, so what I'm going to do in the GDP, in the real GDP, I'm going to take the quantities from each year, produce the quantities for each year, but I'm going to take only the 2001 as a base year, and I am going only to take those prices. However, the base year can be 2001 and can be 2002 as well. So I can measure 2001 as a base year and take those prices from 2001. However, I can measure on 2002 and I can take those prices from 2002 and calculate the remaining year. I can do this annually, every decade, every 10 years, or every quarter. So because the GDP indicators comes every quarter, the measurement comes every quarter. So let's here take the 2001 as a base year and take the prices in 2001 and calculate the quantities produced by the market to understand the productivity growth. So if I take 2001, I will find that the market has produced 100 hamburger and the price was $1 for each hamburger plus 50 hot dog and the price was $2 for each hot dog. So that will be 200. So if you realize here, the nominal GDP and the real GDP, the base year will be always the same. So you find that $200 in the nominal GDP and $200 on the real GDP for the base year. Now let's take this base year and see how much the real GDP was in 2002. So I'm going to take the quantities of 2002, which is 150, but I am going to take the prices from 2001, the base year. So 150 multiplied by $1 plus 100 multiplied by $2. And I'm going to end up by 350 GDP. So if you realize here that the real GDP is different than the nominal GDP because these will reduce the inflation on the prices and will give you the growth on the amount of products being produced within the US market. So let's calculate 2003, 200 hamburger produced in 2003, and the price of the base year is $1 plus 150 hot dog produced in 2003, and the price for each hot dog was $2 in the base year, so total 500. So you can see now how the real GDP is being calculated. So now I want to discuss with you something called the GDP deflator. So what does the GDP deflator means? So now I'm going to discuss with you the formula of the GDP deflator. There is a formula called GDP deflator, and this formula is used to easily calculate the real GDP without going through this calculation. So the formula says that the nominal GDP divided by the real GDP will give you the GDP deflator. So I can flip these two and I can say nominal GDP divided by the GDP deflator multiplied by 100 will give me the real GDP. So you can see that the GDP deflator, when you divide the nominal GDP by the GDP deflator, you're gonna go to come out with the real GDP. So what does the deflator do? It deflates the nominal GDP and reducing it for you to come out with the real GDP. So let's think, or let's see, what does the change of the deflator means. If I will take the 2001 example and I calculate the GDP deflator, so it was 200 in the base year over the 200 of the uh, base year in the real GDP, multiplied by 100, which is 100. And that number will be always the same for the base year. However, in 2002, it was 600 GDP as a nominal and divided by 350 GDP as a real GDP, multiplied by 100, and the result is 171. So you can see the change by the 71% from the 100 to 171. In 2003, the productivity of the nominal GDP was 1,200, and the productivity on the real GDP in 2003 was 500. So if I divide 1,200 by the 500 multiplied by 100, I will be having 240. So you can see, based on the base year, the change from the 100 to 171 is almost 71%. And the change from the base year to the 2003 is 140%. And let's calculate, or let's understand how the percentage has been calculated. So the change from 2001 to 2002 is equal to the amount of the GDP deflator changed by, which is 171, minus the change in the deflator in the base year, which is 100. So 171 minus 100 divided by 100 multiplied by 100, which is equal to 71%. So let's think, if I want to calculate, or if I want to take the base year as a 2002 and I want to calculate based on that 2003. So in this case, the base year change is 171. And the current year 2003 is 240. So the formula is 240 minus 171 divided by 171, that is the change on the base year, because we are taking now 2002 as a base year, not 2001. I'm just trying to show you the base year, it doesn't matter. Multiplied by 100. And let's use the calculator because I am weak in mathematics. So this will be 240 minus 171, the change on the base year, divided by the 171 again, the change in the base year, multiplied by 100, and this will be 40%, equal to 40%. So you can see, what does the GDP deflator do with the nominal GDP. So let's move on into next slide.